welcome back. You're watching Indian Open right here on Bloomberg Quint. So yes, you did see a little bit of pain coming in from the US markets. The fourth straight day of losses coming in across the board there, about 0.5%. But we've also stabilized a bit from the kind of heavy cuts that we've seen in yesterday's session, still picking up in today's trade. So you've got the Nikkei and the Asian basket not doing all that badly. 1% recovery there, 22,112. Shanghai is up in the green. Hang Seng, however, still laggers in the red. For SGX, you've got an 8-point gain there, marginally higher, 11,398, just a smidge away from 11,400. Interesting to see that yesterday's session, particularly for our markets, saw the premium expand. However, the open interest started to come off a bit. Agam is here joining us to tell us what exactly this signals towards. Agam.
That's exactly how you put it, Devina. We have seen some amount of unwinding playing out, especially in the Nifty banking futures. But I'll come to that. Let's start off with the Nifty futures. At this point in time, a decline of around 1% in open interest unwinding coming through, and longs, severe longs unwinding in the Nifty banking futures, where we have had a decline of around 6 to 7% in terms of open interest. So let's pull that up in terms of the Nifty banking futures. There you have it. That's around 7% declines in OI. Moving on, when it comes to the India Volatility Index, as one might expect, and as we had told you that we are likely to see an up move, and now given the fact that the India VIX has gone above the mark of 13, now is the time when all the traders who are long will start to get a little cautious because of the fact that we've seen an expansion in option premiums. That said, when it comes to the Nifty put call ratio, it's currently at around 1.66, as one might expect, considering the Nifty has also come off from those highs. But when it comes to changes in open interest on the Nifty, it was the 11,400 mark and the 11,500 mark which saw the most amount of activity. We saw more writing around the 11,400 and 500 calls, and we saw unwinding coming through for a lot of these puts, possibly profit taking, considering a lot of these puts premium had moved up. Let's move on and take a look at the stocks then, and Apollo Hospitals stands out, perhaps one of the few stocks which advanced yesterday, given we had so much weakness, and Apollo Hospitals did advance by around 13%, 17% added in open interest towards longs. On the other hand, we have a lot of weakness in stocks like Sun TV, that declined by around 8%, 12% added in open interest, and we also had more weakness in something like a Canara Bank, where we also saw more weakness towards fresh shorts. Once again, we are expecting today's day of trade to remain mixed, and all eyes will remain on stocks, considering we have seen such mixed views, and we'll have to wait and watch whether or not that trend continues as we move into today's day of trade.
Let's wait and watch what happens thereof. Agam, thanks for putting this into perspective. It promises to be a very busy FNO show for sure, I can assure you that, even though the start seems to be fairly muted for our markets. However, lots to talk about fundamentally from this market's perspective. Let's get in a fundamental voice. Amit Jeswani should be joining us any moments from now. You heard him at the Alpha Ideas 2020 meet speak about one particular area, and that is Edelweiss, but it just showed how select people understand businesses and try and invest in them, and I think that's what we'll try to do today. Talk about these 3 or 4 companies which have come out with blockbuster numbers and how the businesses are looking like for the next few quarters or few years. You know, Specialty Chemicals, Devina, as a pack has just impressed so well this quarter. Vinati Organics, fabulous numbers, consistent reward for the last 3 or 4, actually last maybe 7 or 8 days. Deepak Nitrite, a case in point.
40% for the year.
For the year, actually for the month as well.
Yeah.
Then today I was just looking at the numbers. Fine Organics, they've more than doubled their net profit. Revenues have grown, margins have expanded some 500 basis points. Might be a case of this company outperforming meaningfully in the session today. Rathi Industries, I think the last 4 or 5 sessions has done very well. This pocket has now come back into prominence all of a sudden in the last 1 month.
Smaller names there, so you are seeing that bit of interest coming back into the small names. Obviously earnings driven, but nonetheless you will see not just the large caps garnering that kind of interest, but across the board small caps driven by earnings have seen a lot of interest.
Yeah, it's just been a fabulous move for some of these stocks in the session today, in the session over the last few days. That notwithstanding, I think the interesting part is, of course, what's happening to the currency sensitives. Now, whether or not the impact is seen fundamentally or no, but yesterday we saw OMCs getting beaten and IT doing very well in trade because of the rupee.
Well, hopefully, I mean, we've got ourselves just a smidge away from that psychological mark of $70. So, I mean, 70 rupees to the dollar. We were at 69.90 to the highest ever. I mean, the lowest ever for the rupee. But even on the charts and technical fronts, you are seeing at least more weakness predominant. So you could see us actually breaching the 70 to the dollar mark, because you've got that MACD crossover that has happened, which could indicate that the rupee could actually move a little bit lower versus the dollar. So we'll get in more experts, and exactly like you pointed out, Neeraj, I mean, what it does for some of these rupee-sensitive sectors as a whole, IT to obviously benefit from this, but we'll see this time around. They already showed some of it in their results, most of them did, and whether or not it continues goes to be seen.
Yeah, well, let's wait and watch out for all of these. But while we wait for all of that, a clutch of important results to monitor, as well as some other key stocks in news to talk about as well. So our research team is waiting by in the huddle to talk about all of these key names. Darshan, Shraddha, as well as Saloni, and then Nikki, of course, talking about the steel numbers as well. Well, all of you, thanks so much for taking the time out and joining in. Good morning. Shraddha, should I start off with you? All results right. And some stocks in news, I believe, both. Stocks
in news. Max, India is one stock which will be in focus, and this is on the back of ET report, which says that Bain Capital has now joined KKR to buy Life Healthcare's 47% stake in Max Healthcare, and that is for about $450 to $500 million. So that's one stock to watch out for. Navneet Education will decide on a share buyback on August 20th. We'll keep an eye out for that name. A small order win for Kirloskar Pneumatic worth about 60-65 crores, and HDFC Mutual Fund has picked up 2.2% stake in NCL Industries. That stock ended about 10% lower yesterday. So let's see if we see some positive reaction.
Yeah, I think the stake buy was at 47, if I'm not wrong, and the stock ended at 44 or something. 147 yes. And 144. Yeah, that's what I meant. So it's ended 3 rupees lower than what the purchase price was. Should be interesting. 2% stake, if I'm not wrong. Okay, interesting. We'll watch out for NCL in the session today. Saloni, some strong numbers that we should watch out for?
So first up on my list is Dewan Housing Finance. The company reported extremely good set of numbers, wherein we saw net interest income growing about 45%, while net profits grew by over 35%. Oracle too saw good numbers sequentially. Revenue saw a growth of 25%, while net profit was up over 70% for the quarter went by. We saw EBIT margins expanding to 45% from 31% seen last year. Fine Organics is another counter that will remain in focus today. Revenues saw a growth of 94%, while net profits almost doubled to 37 crore. On the operational front too, EBITDA grew by a good 145%, and margins shot up to 22.2% as compared to 17% seen last year. Shelley Engineering Products reported good set of numbers too. Both top line and bottom line grew over 25% each. However, margins saw a downtick of nearly 100 basis points and stood around 17% due to higher expenses. Oil India also saw good growth sequentially. Revenues were up 13%, while net profits was down 20%, largely on the back of higher tax outgo. That apart, EBITDA shot up 76%, and margins saw an uptick and stood around 41% as compared to 26% seen last quarter. And last on my list is Lemon Tree Hotels. The company reported net profits as compared to net losses that we have seen last year. Revenues grew by 18%, and margins expanded by a good 300 basis point needed. So we may see some positive reaction here.
Well, very interesting. A clutch of names which have done very well. Thanks for that, Saloni. I believe Tata Steel would fall in that category too.
Yeah, so strong inline set of numbers reported by Tata Steel. If you look at the standalone EBITDA per ton, that's almost more better than what we were estimating, but I'm addressing more so the weak numbers that have come through. If I'm going to be talking about precision camshafts, where the revenue has been down by 7% and the net profitability of the company has declined by 15%, EBITDA is down by 2%. Net, it's the poor top line growth and the operational lack of operational efficiency, which is reflected on the bottom line numbers. Nandan Denim, where the revenue has actually seen a downtick of 15%. Net profit too has fallen on account of decline that we've seen on operational performance. Ashoka Buildcon, where the top line growth is flattish, but then we see an uptick on bottom line numbers, mainly on account of other income. Apart from that, operationally, it has been also a poor show for Ashoka Buildcon, where the EBITDA has come in lower by 12% year-on-year basis to a number of 81 crore as compared to 92 crore. And Asian interesting, Renito, where revenue has seen a 6% uptick, but then profits have fallen by more than 40%, mainly on account of the EBITDA downfall. Maybe the downtick that we've seen in EBITDA by as much as 30%. Margins are at 8.5%. They've contracted substantially to 8.5% as compared to 13%.
Thanks for that, Nikki. Darshan, what's expected from the big boy?
Yeah, so Sun Pharma pretty much the last number of the Nifty that will come out. As far as top line is concerned, we are seeing close to a 12% growth that will come in. Profits at almost 911 crores compared to a loss last time around. There was an exceptional that Sun Pharma had last time around. Because of that, there was this loss that happened because of a provision for some liability in terms of litigation. EBITDA, we are seeing a 23% increase and margins over 22%. Now, Taro, which is almost 15% of the Sun Pharma's total revenues and 50% of the US revenues, that has already reported numbers which were rather weak. So the estimates already will be on the lower side for Sun Pharma this time around. India business will be very strong. Higher contribution is expected from the India business. On the US front, we are expecting a flattish year-on-year growth and 10% sequential downtick, and probably it will come in even more because Taro has disappointed. A couple of products have launched. Venchol, there is Yonsa. All of them have been put in. There's resolution of the Halol plant, but nevertheless, pricing pressure will continue in the US markets. R&D costs are expected to be lower this time around, and that will aid the 22% margin for the company. And there will be costs related to the specialty pipeline of the company, which will also have an impact as far as the margins of the company are concerned.
Great. Darshan, thanks for putting that into perspective. We'll watch out for Sun Pharma, and of course, Darshan will keep us updated with what happened in the quarter gone by. But we have a fundamental guest with us, Amit Jeswani. Needs no introduction, really joins us on the show. Amit, good having you. Thanks so much for taking the time out. You know, love talking about businesses, looking at the numbers and some fantastic results by select band of companies. Let's start off with the big boy, Tata Steel. Did you have a chance to look at the numbers, and what did you make of them?
So Neeraj, good morning. Thank you for having me on your show. I've not looked at Tata Steel's number. It's too big for me to understand. But overall, the steel cycle remains very strong. But you don't want to be in low quality this year. So cyclical names will underperform. But if you have like a 3-year, 4-year horizon, I believe steel cycle is going to be super positive. The prices, so if someone's seen Game of Thrones, the guy keeps saying that winter is coming. So this winter onwards, after November, you'll see a huge sprint in stock price in the prices of steel, and it crossed 52,000 again. That see the prices like went from 36,000 last June to about 52,000 in March. From 52,000, the prices have now corrected of steel prices to about 46,000 broadly. Now, when the winter comes, China shut down capacity and the prices will move up again. The steel cycle is here to stay for the next 3 years. Big money can be created here, but I don't track Tata Steel, but overall the cycle looks super strong. The capacity utilization of the sector has reached 82%. To make 1 million ton of steel, you need 7,000 crore rupees. Banks are not going to lend you any money. That is something which I can with conviction say to most companies. So no new capacity will come, but demand will keep growing at 7-8%. Import will not happen because India has put anti-dumping duties, plus China itself has cut down capacity from 1100 million ton to 800 million ton. So China doesn't have excess capacity to export to you. So steel cycle will be super strong. A lot of money will be created here in the next 3 years. I don't track Tata Steel, but I like the leaders of every sector. JSW Steel is the leader here, but overall the sector should do good.
Amit, good morning. Devina here. What is the call on the index now? I mean, looking at the way we've been moving, obviously jitters across the globe weighing down on us as well, collateral damage for us, but still, are we holding strong according to you?
Okay, so good morning, Devina. The first thing is that rupee has now given a breakout. Okay, this is a 5-year breakout above the 69 level. Normally, whenever a large range shift happens, if a stock or any company or any currency breaks out after 5 years, you will see the impact at least for the next 5 months. That is just normal behavior. So the next few months, I expect the currency to move north. How we placed on the index, if you see what we have been buying, see the leaders, the market tells you where you should be. Large caps were the ones who fell the least, and they were the first ones to make a new high, right? So technically, if you're speaking, like large caps is the place to be this year. We still believe that there is more room to go, but see, there are two kinds of portfolios. Like within our portfolio, there are two kinds of bet, and this is a very interesting thing. There are two kinds of portfolio inside our portfolio. One portfolio is where we bet with high conviction of reasonable returns. These are normally companies which grow at 20%, secular growth companies. So that is the core part of the portfolio. That is 50-60% part of the portfolio. The second companies are companies where with reasonable conviction we can expect very high returns. So that is basically where the alpha comes for us, and these are these 30, 40, 50% kind of growing companies. So so this year we have been tilted more towards our core rather than taking on alpha bets, because there is uncertainty around the globe, in India, political uncertainty. So this, and we've also not cheap on valuation. So this year it's better we relax. No big deal. We were the first ones who turned negative this year, but we're not as negative now as we were, like say in January or February. But this year you have to protect your capital. That should be priority number one. Returns will come. At 2019 onwards, we expect huge rallies to come in the markets, but you have to be sector specific. That's important. And yes, so sectors will look at sector tailwinds, and that's where big money will be made.
But equities for us, if we stay at these current levels on the currency as well, and what's been happening globally, you think there will be a flight of money to safer haven assets, and there you will see actually cuts coming into total allocations as well to equity?
See, actually, we're always invested in the market. So we actually look at tailwinds. Where are tailwinds? And that's where we invest. It is very difficult to predict macro. There are only two things we understand. So this is one place we cannot understand Turkish economy. We know that we don't know. See, a lot of people will start analyzing Turkey and all those things, but those things don't matter, because China has also devalued its currency. There are only two things any retail investor or HNI investor should look, because these are the only two things which have very high correlation with your flow of funds. One is how is rupee doing, and the second is how is emerging market index doing. If you can understand these two things, you will understand the liquidity part. So on the liquidity part, the emerging market index has given a breakdown below the levels of 45, that is MSCI emerging market index, and even the rupee has given a breakdown in sorts. So basically the flow of funds will be weak for the next few months, I should say. So on that we're not so positive, but see, we have to look at sectors, look at the numbers which are coming. They're just mind-blowing. Like this quarter is like a Lollapalooza quarter. I have rarely seen a quarter as strong as this one in the last 5-6 years. Except for like 3-4 companies out of 100 companies I track who have not performed well. The numbers look fantastic this quarter, and new trends are going to be created. There will be new sector leaders, and I am expecting good wealth creation in the next few months, years to come.
Amit, do you track the specialty chemical space? Vinati, fabulous numbers. Last evening, Fine Organics came out with a splendid set of numbers. Any stock that works for you here? And the reasons thereof, of course.
Neeraj, yes. So we've started tracking the specialty chemical space. We own one stock who's the market leader, who's got 70% market share in rubber chemicals. That is Nosil. But we've been holding this for the last 2 years in our model portfolio. We have some 7% weight there. But except that, I am very happy. See, actually, I'm going to give out my thesis here. The thesis is very strong for chemical companies in India. If you just look at one company here, Rathi Industries. Okay, Rathi Industries. So everyone knows there are problems in China, and we had just conducted a one-on-one meet with one of the largest importers for chemicals in India. So when I asked him what's happening, and he's the guy who's the biggest supplier to Bodhal and Rathi Industry and the kind. One thing which is very, very, very sure, the chemical 2.0 is coming. The crises have gone in China look as bad as they were before. and you will see a lot of, now let's take an example of Rathi industry. First of all, there are more than 5-6 CEOs of Chinese company in India now as we speak, looking to partner with or looking to invest in a factory in India because they need to hedge their supply chain commitments that they have done. Thing number one, look at Rathi industry. Just open any investor presentation and ask everyone to do this. We don't own Rathi industry, but this is just for purposes of discussion. The thing in chemical, why were chemical companies not ever getting valuation? The reason chemical companies would never get valuation because you could not predict. Okay, chemical business works on spreads, basically. Let's say the raw material spread and the finished goods spread, and that was the problem. And low ROC because the fixed cost investment was very high in chemical sector. Now what is happening? Let's take an example of Rathi. Okay, he signed 2 contracts. One in the last contract was a 4,000 crore contract for 10 years. The Chinese company has given Rathi industry money to invest in plant, and Rathi industry has got guaranteed revenues for the next 10 years. So basically it becomes a high ROC business. Yes. So it becomes a very high because you are giving, the customer gives you money and basically you're making money from his money. It becomes a very predictable business.
So you see this happening?
I'm liking the chemical space a lot. There are a lot of players actually.
Okay, that's what I was asking you. You see this happening across the space, and therefore is no-sell another kind of that idea? I mean, you would believe no-sell is a good investment even at the current levels, Amit?
Absolutely, absolutely. The company looks good. So look at the margins. See, companies, there's a regime change. These companies used to do margins of 12, 13, 14%. Look at no-sell's margin, somewhere around 28, 29%. March quarter was 31%. So basically, this is the new normal. Markets will take time to recognize, a few more quarters of consistent performance, and people will say, okay, the 30% is the new normal, and we should 28, 30% margin is the new normal, and the stock should get valued at those levels. See, there are rarely any companies who can make 30% operating margins. This is not a commodity anymore.
All right. Watch out for those stocks there. 12-month gains on no-sell of 31%, but over the last 6 months, not done a whole lot. It's dipped by about 12% Let's go across and find out a little bit more on what you can do on the technical front. Gaurav Bissa of LKP Securities joins in right now. Gaurav, thanks very much for taking out the time. While we're talking about the index a whole lot, a few stocks that you would like to first initiate your calls on and how you would trade them in today's session.
Good morning. The first recommendation today would be on NCL Tech. We have seen NCL Tech has been consolidating in a narrow range for last 7-8 trading sessions. It's now come out of that range. Some amount of short covering has been seen. A reduction of about 2% in the futures segment has been seen. Given a small breakout from this consolidation range, it would be more of a trading bet for a day or two. One can play with the stop loss of 970. Buy NCL Tech futures for target price of 1010. Second would be a sell call on JSW Steel. We have seen time and again in last few weeks that 345, 346 is proving to be the Achilles heel for the name. It comes to around those levels and then gives a strong reversal from those areas. And whenever we have seen a reversal coming from 345, 346, it has retested the support band of around 332, 335. Same is the case this time around. As long as it's trading below 345, it will be a strong sell. Stop loss of 346 half on the futures, and targets would be 338 to 335.
All right, Gaurav, do you have a call on United Breweries after yesterday's sharp move?
We had recommended United Breweries yesterday, but it's moved up quite a lot. If somebody has bought earlier, no harm in holding. Fresh longs are to be avoided at these levels. The risk was not favorable. Supports are seen at levels of 1245, 1250. So a 50 rupee stop loss from here in the futures level would not be too advisable. So buy on and dips towards levels of 1255, 1260, stop loss of 1225. Again, it can retest levels of 1310. At 1300, I would not be interested.
Interesting. Gaurav, for somebody who's trading the index, what levels would you recommend? Are you going long, going short on open today? Because we'll start off arguably in a very flat note.
It's a very tricky situation as far as Nifty is concerned. There are a couple of aspects I would like to discuss. If you look at the option chain, 11,500 call option commands the highest concentration. We are not seeing aggressive writing happening day in, day out, but yes, it has a very high concentration. Market will respect that. So any rise will be met with some amount of pressure in the index. On the other hand, if you look at the put side, 11,200, 11,300, put commands a good amount of concentration. So supports are seen at those levels. Then if it's trading in a range, how can we get any trigger? How can we get a signal? If you look at the technicals on 4-hour charts in Nifty, it's trading just to the support levels of 11,333.20. If these are sustained, we can expect a strong up move coming in. Probably a fresh high can also be seen in Nifty in coming days, provided we are sustaining levels of 11,320, 330. What we are advising to our clients to be on the long side, have a small source of 30-40 rupees and play for 100 rupee and 50 rupee kind of targets coming in. I would be sure if it trades below levels of 11,300 spot levels.
All right. Just come in, Gaurav, on the metals pack as a whole. Last few days, obviously, the kind of run-up we've seen is also backed by the earnings performance, so there is a fundamental drive to it. But interest has been building up in the futures and options space, as well as technical support for the likes of Hindalco, Tata Steel. Do you see more interest here in this pack?
If somebody wants to play for a short-term downside, these are good enough levels. Even for Hindalco, it can fall another 2-3 percentage points. The overall trend is not very weak, but yes, for the time being, we can see some pressure coming up. Any jump in these levels, in these names, are used to build fresh short portions. We have seen a lot of writing happening in out-of-the-money call options for Hindalco at 230. We have seen decent amount of writing for JSPL 220, 230 zone has been a good selling area, and as far as options are concerned. So there is going to be some pressure that cannot be ruled out. But for the time being, if somebody wants to play, as I mentioned, JSW Steel for a small dip, and if somebody wants to play for a long side, Tata Steel, if it sustains level of 590, 595, we can see a strong short covering rally coming towards the level of 625, 630 in a matter of 2 or 3 days. I would buy Tata Steel, but not at the levels of 575, 580. Above 590, 595, it would become quite lucrative.
Okay. Amit, Gaurav, stay on, so much more to talk about. Amit, a lot of numbers that have come out over the last couple of days. What have you made of the liquor numbers? United Breweries, the numbers seemed okay. Gross margins at least seem to be okay. The stock rallied quite a bit on what was reportedly just an ordinary quarter. Som Distilleries has come out with numbers, and the numbers don't look all that great. What have you made of these liquor companies? Would you have an investment call on any of these?
So Neeraj, we don't own any liquor companies in our portfolios currently, but the space is good. If you see globally, they have created a lot of wealth. So it's a proven business model. Globally, though, you don't have so much government interference. Some distilleries I do track, but it's a very not so good set of numbers, I would say. I'm very disappointed because this was one stock which I was looking at it closely. It fit all my criteria as high growth, new product. They are market leaders in the niche, 45% market share of Hunter beer in Madhya Pradesh. Basically, you're better than Kingfisher in a state, so you are doing something good. So it was something which was a very exciting story, but clearly they've not done as they've guided. So yeah, so that's that. But I don't have very strong coverage. Radico is also good, United Spirits also good, but yeah, so Radico was basically that molasses trade, but Som is not a molasses trade because in beer you don't need molasses. But let's see what happens. But I'm not have very close tracking this thing on this. But Som I do like for long term at a very big dip. If
you see Neeraj yesterday's move on United Breweries, it is just broken above that overbought region after yesterday's big move. And if you see, if there is a candlestick that you can see, it's a big long body. Opening was lower, closing, and it closed near the highs of the day. So big volumes, higher price momentum, 7.5% plus on the stock, and as you can see, a big spike there. Body of the candlestick also longer, which indicates that this was led by volumes, and the RSI there has broken to 70.3. The RSI signal comes in at 70. Last time we breached this was in the month of November last year. So this is a positive indicator for United Breweries.
Yeah, let's wait and watch what happens there. 7.5% up for UB in the session yesterday. Let's see if that lasts or no. Some numbers that came out yesterday, and I think 2 or 3 good names out there. Amit, do you track companies like Apex Frozen? The numbers optically seem to be okay. It's in a niche space of its own, so to say.
Yeah, we had positions in Avanti Feed actually. We didn't track Apex so closely, but there's a 3x expansion here. So all these things don't matter. The most important thing is that the expansion, which is the key here. But we don't have any close watch on the prawn story anymore. See, the tailwinds which were there are not as strong. I'll just give me 1 minute and explain you this. In Thailand had 15% market share in prawns. Because of one disease, the market share became 6%. Vietnam had 14% market share in these shrimps, and because of one disease in 2013, the market share became 7%. So basically, this is a lot more volatile than people actually think. But yes, so we don't have positions anymore. We've exited Avanti Feeds and the whole lot. But yes, we've been tracking, but not so closely. But the trade in Apex is 3x expansion capacity.
So what results have impressed you, Amit, in this quarter gone by? Now we are at the fag end, except for one Sun and a few other tiny tunes. Almost everything has come out. What's that one number that stood out for you this earnings season?
I'll tell you one full theme which is working very well, and that is the lending theme. Look at the numbers. AU Small Finance Bank, 61% growth. And see, where's the largest tailwind? AU Small Finance Bank, 61% growth in AUM. Yesterday, as Saloni rightly said, DHFL, mind-blowing set of numbers by DHFL. PNB Housing Finance, 50% growth. So the entire NBFC pack, so basically everyone was expecting, so retail credit is just getting started. That is one place. You look at from microfinance companies to SME lending companies. These guys are just getting started. The lending theme is the one which is like the most impressive, because we were all expecting 30%, but these guys are coming up with 50-60%. So they're beating the highest estimates. So that is one place where I believe, like, look at DHFL yesterday. This is a housing finance, a slowdown in the housing finance space, and DHFL is growing at 35%, right? But when the real affordable housing boom comes, which is expected in the next 1-2 years, you know, what would be the growth rate? So a good longevity theme. All these stocks look good. We have positions in DHFL, so just a disclosure here.
Just want to mention out here that if you log on to the website bloombergquint.com, and there is a tab for Alpha Ideas 2020, out in that presentation, Amit Jeswani has made a very nice presentation on Edelweiss. That forms a part of the lending theme, no longer just a brokerage theme, but a lending theme at large for Edelweiss. And he explains his rationale as to why it might be worthwhile to have a look at investing in companies in this space, particularly Edelweiss. So do log on to the website. There's a tab for Alpha Ideas 2020. You can go in on the tab and see numerous presentations, but the lending theme that we were just talking about, Amit has made a presentation out there on Edelweiss. So this is the tab you need to go on to bloombergquint.com.
Well, Edelweiss is not surprised on the earnings run. Also, 29 straight quarters of profit for the company. I mean, but somehow on the day of the results, you know, always due to already pre-anticipated and pre-built-in, you know, good numbers, the stock doesn't do well. So it kind of takes some profit off the table for people who've already taken trades in Edelweiss. But Gaurav, on the stock?
Well, if you look at Edelweiss, it has been trading in a range. It had given a breakout sort of above the levels of 310, 315. Right now, it's trading in the support area. There's a band, there's a support that we can expect at the current market price. I would wait for some time. As you rightly mentioned, it's seen some amount of profit booking already at the levels of 280, 285. I would not be too keen. If somebody wants to buy above the levels of 295, in which case you will see a strong short-term base formation happening at levels of 275, 280, and a degree of confidence would also increase, and it can head towards the level of 320, 325. There's a strong breakout in the making above levels of 325. One can buy about 295, have a stop of 280 on the upside, targets of 315, 320 can be seen.
I just want to come to you, Amit, on the banking space as a whole, post numbers and results. I mean, looking at valuations as well. According to Bloomberg analysts, potential upside in the likes of Yes Bank, ICICI Bank and Bank of Baroda. Their price to book is also not that expensive, with the Yes Bank at 2.8, ICICI I think is at 1.8 times, and Bank of Baroda is at 0.9 times. Do you think these are good enough to make an entry point?
So I like retail lending a lot more. So I would stick with the IndusInd Bank. See, there's a big opportunity in corporate lending as well, which is built up. But I like the IndusInds, Kotaks. I still like them. These are the guys which will keep giving you 20% return year over year over year. There's a large opportunity. PSU banks. See, when you bet on a bank, your bet is always on the banker. So PSU banks have no banker only. Every 2-3 years you'll have a new banker. So we've not been tracking only that space, to be honest, anymore. So that is one space I'm super convinced that I don't have to track that space. But there'll be odd years where they go up 50-70%, but you need consistency. You know, the stress adjusted return in these companies are not worth it. So you can't take large concentrated positions. We normally have a 10-15 stock portfolio. So we don't buy these companies, PSU banks.
Yeah, so Yes Bank
Yes Bank is a very super story.
Yeah, so Yes Bank
absolutely.
has...
So Yes Bank, just one more point I want to make. Yes Bank, if you believe that if the numbers are true, this guy is a legend. Okay, that is the only point I want to make, because you cannot see, think about it, when your entire sector, like SBI has 20% NPAs on its corporate book, 13% NPA ICICI Bank has on its corporate book, 9% NPA Axis Bank has it on its corporate book. There is not even one company which has less than 6-7% NPA on its corporate book. But on one side you have Yes Bank who says I have NPAs of 1.20%. So I don't know, it's too good to be true, so that's why I'm not there. So that's the only reason.
To stop you there,
like, if you
we've got market pre-open in about 30 seconds, so we'll come back to that discussion in a bit. But I quickly wanted to look at SGX Nifty. Asia is trading a slightly mixed bag position right now. Shanghai is down 0.6%, Nikkei is up 1.7. SGX Nifty has floated into the red by about 0.25% or so, 14 points lower, 0.1% lower on SGX, 11,376. You're going to be watching out very closely for where the rupee opens this morning. The ticks should come up on your screen and the kind of opening that we've had. So Nifty, the initial move is up 1.45% on 67 points, but that will stabilize. Sensex at 37,968, 320 points higher. Some big moves coming in on HDFC Bank, up 10%, but obviously there's no volume right now and the prices will also correct itself. Tata Steel is up, splendid quarter, a great profit number, doubling it. Stocks up 10%, Infosys up 8.6%, and these are all, remember again, IT is going to be the center of focus with the weakening of the rupee. Infosys is up about 8%, Eicher Motors 2.8%, SBI is up 1.9%, HPCL is up 1.9%, Tech Mahindra 1.3% higher there. Indian Oil is also gained. Some of the other gainers are Wipro, Yes Bank. These are all up about 0.8%.
Bring up the currency if we can, and let's see what the currency is doing. The rupee at open is at 69.78, so some bit of a pullback there. But let's see, early days as yet. During the course of the day, there might be some weakness. Let's wait and watch what happens there. The currency not breaching the 7-3 fortress as of now. It might be a matter of time. The bond yields should come up on your screen as well, and let's see what they are doing. 7.82. So, well, slight shift from that 7.75, 7.76 to about 7.82 in early trades. Let's see if that lasts or no. What seems to be lasting is the gain on Tata Steel though. Early days as yet. Let's wait and watch if it does have this 7% uptick or no. Vakrangi is looking like it will start off on a somber note. For now, showing a downtick of 20%. Let's wait and watch if that lasts. Page Industries should come up on your screen. Delta Corp should come up on your screen. Let's see if there are reactions. Well, might be another 2-3-4% for Page. MSCI inclusion, Delta Corp, minor downticks. Actually, not even a downtick. It's just a flattish start for Delta Corp. Bring up Fine Organics. There might not be trades. Let's wait and watch. No, actually there are. A very strong quarter, and let's see if this one has some upticks. OFSS fairly decent numbers. Let's see if this one is reacting on a quarter-on-quarter basis. The numbers seem very good. Let's see. Well, minor uptick right now, about 1%, but nothing too dramatic. All in all, it's a start that is flattish to marginally higher. The Nifty now showing an uptick of about, well, 29 or 30 odd points. This could well be the kind of start that we'll have. I doubt we'll really have a 1% uptick really. This could well be the start that we will have in the session today. Gaurav, Bissa, what seems to be doing well at the start, at least the first couple of minutes, are the HDFC twins. They've been out of action for some time now. As a trader, would you look to trade either HDFC or HDFC Bank at all, or there are better stocks to trade on the financial side?
HDFC Bank is just about trading near the support area, but I would not consider it as a liquidity trading opportunity. 2060 is the immediate support. If there's a dip towards 2080, 2075, one can use a stop loss of 2060. On the upside, targets of 2120 can be seen. And these are, not very lucrative trades. There are better opportunities. I would play for stocks that have already bounced from the support areas or that have given a breakout sort of. That would be more lucrative. But yes, if somebody needs to play among the two, it's going to be HDFC Bank.
I just want to quickly pull up the losers on the index as well. So you've got the oil marketing basket, which seems to feel a little bit of pain in today's session. So HP, CL, that's the one that's down. You've got the Power Grid, which is down about 0.25%. Reliance Industries is down 0.5%. Hindalco loses, that's a top loser, in fact, down to 220. Ultratech Cement marginally lower, and ICICI Bank takes a cut of about 0.25%. Any banks in your list, Gaurav?
Yes Bank was the one that was looking for interesting. I would buy Yes Bank, but not at the current levels. You buy it about 375, stop loss of 370 on the upside, 390 can be seen. Private banks are looking a tad bit better. There's a lot of volatility that we are seeing in the PSU banking space, but among the private names, Yes Bank is looking good, even Kotak is looking decent for that matter. It's been sustaining levels of 1275, the immediate support level quite well. One can use the stop loss of 1275, play for immediate target price of 1310 to 1315.
Tata Steel looks like starting off on a good note. Gaurav, if it starts off at about 580, 584, what would an ideal trade be?
As I said earlier, 595, 95 is a very strong resistance area. We have seen strong reversals coming from those areas. The safer trade would be to buy above levels of 595. At 585, 588 levels, if this is where it's opening, playing with an option would make sense. Buy a 600 call option or a 620 call option for that matter. The results are already out. The IVs will drop once the market opens. So there's not going to be any further IV drop that one can expect. It will purely the momentum based recommendation that can work. So in which case I think buying a call option would make more sense, and if somebody wants to play with the future or slightly longer period, buy only about 595.
Okay. Amit, I want to come back to the point that you were making. Did I summarize it? Am I summarizing it correctly when I'm saying that you would look at Yes Bank closely, may not invest in it, but if the numbers are to be believed, then Yes Bank is a prime investment candidate?
Absolutely, absolutely. It's a no-brainer. You know, the corporate banking space, you become a vulture right now. So you are the ones who has the pricing power. The guy who's sitting like in your customer has no choice but to go with you or any NBFC who can do corporate lending well. So Pyramid is doing very well. That's one place where I trust the numbers.
You would go out and initiate some investments into Piramal. There's another reason too. There was a report recently, which the company of course has shaken off, but the report of the demerger, the much spoken about demerger that could finally happen, that is also, to be honest, a technical trigger.
Absolutely. So we own Pyramid for the last 1.5 to 2 years also. So we don't miss out these growth stocks. This company is growing at 40-50%, super high quality management. See, what do you want? This company had a return on equity of more than 25%, high quality management. This company is minority shareholder friendly. They will demerge. So these are the kind of bets we take, you know, growth, ROC, ROEs, good management, yes. So in real estate, I'll just tell you one interesting thing, Neeraj, since we are speaking about Piramal. A lot of people, including me, had worries about what will happen to the real estate book. So they have lended basically to 1.3% of the real estate builders in the country, but they in aggregate those 1% builders do about 8-9% of real estate sales. It's a clear show that the trend is clearly shifting from unorganized to organized in the real estate side, and that's going to be a big super trade, not today but a few years from today. The organized to unorganized in real estate will be a very, very, very large trend. But yes,
to track the oil marketing basket and post the results coming out from there, do you see any more interest? I mean, the likes of an HPCL, they are on the right track. They want to capitalize on growth potentials. You're seeing a lot of interest building up in the lubricants business across Asia, West Asia and Africa for them. So are these the right tick marks for these companies?
I'm so sorry, I don't track any, rarely do we track government companies. We bet on entrepreneurs. So entrepreneurs make money. Government, their interest is not to make a lot of money for you. I don't think so.
Well, that should be interesting though, what the likes of HPCL, etc. do. But I think the answer there could well be, let's see what crude does, because hitherto they have shown that while we were talking about the resilience of the aviation and the OMC space to crude price uptakes, the last couple of months have shown that the resilience is, well, maybe not as strong as people or bulls would like them to be, and the correction has been rather steep. But it's a good point to take up with you, Gaurav Bissa. From a trade perspective, OMCs, which have looked slightly wobbly yesterday, would you go out and initiate a fresh trade on any of those?
As far as buying is concerned, I would not be too interested. Likes of HPCL are just about trading in the support area. Any trade below 274 would be a decent sell to play for targets of 265. Have a stop loss of 278, 279. But buying, I think for HPCL, as long as it's trading below 300, one should be avoiding HPCL on the long side. A lot of trading that we're seeing in 300 call option, and that's not been just a day or 2 day trade. That has been trend for last 2 or 3 months that we have seen a lot of trading happening, a lot of reversals happening from 300 marks. So I would wait for that time. BBC, I don't see too much of trade, but as for HPCL, one can sell below 274. We can see some more pressure coming up.
Amit, are you watching what's happening with Jet Airways? You have news every day coming out with management talking about how there are a lot of speculative reports on what exactly the management is doing to tackle the crisis that the company is facing. The stock has declined since last December. It started this selling route. Now it's down to 283. Amit?
See, Jet will, I'm not so sure. See, we bet, hello?
Yeah, go ahead.
Hello? Yeah. So we bet on market leaders. So not that we have positions in Indigo also, but that is one place we like a lot. So the day they can sort out their Airbus problems, see, wherever there are market share gains, that's where big wealth will be created. Indigo doesn't need capital to grow. So that is one. If you see Indigo's ROCs, it's like, if you see the core ROC of Indigo, it's more than 100%. So that's one business we like, but we don't have any positions in aviation sector. But one person problems is another person's advantage. So I think out of the Jet route, the bigger beneficiary would be Indigo, and that's a market leader, 41% market share. 1 year back it was 38%, 2 years back it was 33%, 4 years back it was like 5 years back it was 25%. So basically there's a clear shift happening to the lowest cost airline guy, and that's been always the case. Southwest won over everyone else because it was the lowest cost airline guy. So the cost is very important. Jet is way too high, the costing. If you look at any parameters, Jet is more expensive. The fleets are older for Jet. So Indigo is a better bet if you really want to bet on aviation, but this sector has its own problems, and so you have to be a little careful.
For sure, that's understating it. Amit is just being kind enough to the space right now. Anyways, just minutes away from market open. Stay on, gentlemen. We'll take in one final thoughts from both of you as well, but let's tell you all that you need to know, or let's tell our viewers all that they need to know to stay ahead in trade today. Page Industries adds another feather to its cap. Apart from the dream run it's been having off late, it's the latest addition to the MSCI Global Standard Index. Wakrangi has been omitted from the index, as is Delta Corp from the MSCI Small Cap Index.
Earnings today include Grasim, Sun Pharma, Dilip Bilcon, Fortis Healthcare, Rain Industries, SpiceJet and Shankara Building.
Amongst earnings that were reported yesterday, Shelly Engineering, Kesoram, DHFL, Oracle Financial and AstraZeneca Pharma came out with strong numbers.
Tata Steel and Tata Chemicals results met analyst expectations.
While Precision Camshafts, Nandan Denim and Ashoka Buildcon, as well as Asian Granito, reported a weak set of numbers.
And in bulk deals, HDFC Mutual Fund has acquired 9.9 lakh shares in NCL Industries.
Well, that stock, a 2% stake in this company. This is another company though. This is not the stock, but NCL is priced at about 144 or thereabouts. HDFC AMC acquired that stake at about 147. The stock starting off 3.5% higher, or looks like we'll start off about 3.5% higher. Let's wait and watch what happens there. From the pre-open session, if the rates are to be believed, Tata Steel will start off on a very strong note, so that's actually good news. Yes Bank, the one that we were talking about so extensively, might have a slightly soft start, but remember, it's just in a day. Over the slightly medium term, Yes Bank has done exceptionally well for itself. From the broader end of the spectrum, Page Industries and Vakrangi would be the stocks to focus on. However, it's probably time to take in the top stock of the day. It'll be interesting to see, Devina, if the MSCI additions have a continued run during the course of the day or not.
Well, let's go across. Gaurav Bissa is there. He'll be able to give us his top calls for the day. Gaurav, as we enter a trading session today, a top call from you?
It would be HCL, as I mentioned, decent amount of covering has been seen coming out of the consolidation range. There's a possibility it can head towards of 1,010. If that is sustained, we can expect for further up move coming in. So HCL would be my bet today.
You track Page Industries?
I do track Page Industries, and it's moved up quite a lot. For me, when you're playing with futures, this adjustment becomes of paramount importance. Already moved up quite a bit. I would not be too interested in buying at these levels. If somebody has, one can book out. It's moved up quite a bit, and we are not seeing the kind of OI additions that would be justifying the move that we've seen in the stock price.
Well, okay, but 33,680 Page, thought of by most people is very expensive, continues to rise and shine today, though. As we said, Tata Steel could be amongst the stocks that could be winning big time in the session today. Watch out for the oil marketing companies and watch out for the rupee sensitives as well in the session today. The currencies plowed back some of the losses, might be temporary in nature, but we haven't breached 70, which is the key thing. USD INR, in fact, 69.74, so it's a very strong start today. But here's the market open this Tuesday morning ahead of the Independence Day. We're starting off about a quarter of a percent higher for the Sensex. The Nifty Bank about a quarter of a percent as well. And the mid caps and the small caps should come up on your screen. Don't tell me doing too much. It'll be different from what the large caps are doing. And no, it's not. The mid cap index a quarter of a percent. The small caps about 0.1% higher in trade. So a flattish start, marginally positive. Let's bring up the heat map and show you what's moving and what's not. Hardly any losers. L&T is the top loser in the session today, but look at the gainers. Some banks out there, Tata Steel right up there, 2.5% post the numbers, which, as Nikki said, met estimates, but a good quarter. SBI and Axis Bank about 1% and a quarter. HDFC and ICICI Bank participating. So the banks are right up there. ICICI Bank too in the green. So the Nifty Bank is the one which is propelling whatever little gains that we have on the index right now, about a quarter of a percent, largely, I believe, due to Nifty Bank. I just want to mark 3 stocks before I hand it over to Devina. Firstly, Page Industries. After the phenomenal move that we've seen the last few days, another 3.5% inclusion in the MSCI, adding some more weight. This is now what, 61 or 62 times FY20 earnings. But the market loves it. Vakrangi booted out of that space, of that index, MSCI, and that stock is down another 15%. Shouldn't come as a surprise to anybody. The one that's not quite reacting to that news is Delta Corp, and that stock is likely to start, at least started off very flat and currently to very, very flat. So no big reactions to Delta Corp. Devina, what are you spotting?
Well, a few stocks which are gaining ground in the broader markets. Bajaj Electricals gains ground by about 2%. The stock's at 569. You've got HDIL, that's gained ground. GMDC at 121. PC Jewelers, the stock, and VIP Industries, two stocks which have been consistently doing well, again in the green by about 1.8%. Balrampur Chini, Indian Bank, these are two stocks which are doing 1.5% apiece. IOB is up 1.25%. PTC India. Oriental Bank is gained ground by 1%. Capital First is up 1%. Delta Corp, like you highlighted, now moving up 1.2%. Sterlite Tech, you've got Andhra Bank also, which is doing okay for itself. Among some of the losers, to quickly highlight in the broader market, Chennai Petro is down 7%. You've got Gati Limited, which is down 3.5%. Ashoka Buildcon, Greaves Cotton, AstraZeneca is down about 2%. Jet Airways, some more flack, and you've got more pain coming in there, 281 on the stock. United Breweries, after the stellar run yesterday, some profit taking off the table, 1283 on the stock. Chambal Fertilizers, TTK Prestige are down by about 0.5%.
Well, interesting moves out there. Gaurav, Bissa, before we thank you, opening thoughts. The index has started off on expected lines, but the Nifty Bank has recouped some of the losses. Any trades that you would take on open?
Bank Nifty, any dip towards level of 27,880, 900 can be bought for targets of 28,050, 20,100. Stop loss can be 27,800. It's a small breakout sort of. We're seeing some short covering in the banking space. I think it's looking quite interesting. One can buy on a dip of 20 points for at least a percentage points target in Bank Nifty.
Okay, leave it at that, Gaurav. Thanks so much for joining in. Amit, before we thank you, if you are at a liberty to speak about the latest addition to your portfolios with an assumption that you guys have already completed your purchase. Again, I repeat, if you are at a liberty to speak about it.
Focus on financials, that's all I can say. That focus on financials, that's where big money can be made. Yeah, so that's going to be the leader of this bull market. That is something I'm very sure about, and consumers.
Okay, focus on financials and consumers. Not surprising there. Amit, Jeswani, so good having you. Thanks much for taking the time out and being with us today and giving us your thoughts. Really appreciate your time. That's Stallion Asset Management speaking about their focus points. Let's get in one more special voice. Chakri Lokapriya, Managing Director at TCG Asset Management, joins us right now on the show. Chakri, so good having you. Thanks much for joining in. Well, this morning seems to be about commodities, not financials. To a certain extent, yes, but it seems to be dominated by commodities. Tata Steel numbers out, oil marketing companies very sensitive to the rupee movements, down yesterday, marginally higher in the session today. What have you made of all that's happening within this pocket in the recent past?
Well, if you look at metals, it's a tale of two halves in the terms of you look at their volumes and pricings are up, multi-year highs, 3-year highs, 4-year highs. And if you look at the stocks, they're all year-to-date down. And partly they were all down in the mid-cap correction and the overall correction and the uncertainty of the global events. But the demand is continuing to be very strong, will continue to be strong for at least the next couple of years. And when you talk to aluminum manufacturers or steel manufacturers around the region, not just India, you can see many of these guys are actually expanding capacities, debottlenecking, because they're seeing end demand. So against this backdrop, I think valuations look attractive, and I would be a buyer of all the frontline metal names.
All right, Tata Steel there, FY20 PE at about 7.63. So does that look like a fair valuation for you?
Tata Steel has a couple of things going. One is because of the recent acquisition, their net profit margins are lower, their debt will look slightly higher. But once the iron ore integration and various other synergies take place, then the numbers will start looking far more attractive in terms of earnings, which are not there right now because of some of the recent Bhushan Steel acquisition. So I think from that perspective, yes, the valuation looks fine for Tata Steel, and I would be a buyer at current levels.
All right. We've passed through almost the entirety of the earnings season. Any specific pocket that disappointed you?
Well, disappointed in the sense that you are continuing to see a slippage of in some of the PSU banks, but SBI has been good in terms of they've upfronted all their losses and they've increased their provisions, which is a good thing. Not just a good thing, it kind of has a signaling mechanism that they are comfortable taking it upfront. But some of the smaller banks are still having problems. The power resolution is still not clear, which is reflected in what's happening to Union Bank. So I think that is going to be the most important thing to watch out for.
Interesting. Chakri, you know, you have this penchant for picking up specific pockets, mid-size, small-size, and watch them grow over a period of 4 or 5 years. So the contrarian question to Devina's question, anything that stood out really well for you? I mean, you looked at the numbers and you said, wow, how did I miss this?
Yeah, if you look back at the last 2-3 months and the carnage that happened, the number of stocks that corrected, the two big sectors which got hit was one, industrials, and second is consumer discretionary. And industrials, it was a fear that maybe the government will slow down in its execution, and therefore the stocks came off, which turned out to be not true, because the current quarter earnings turned out to be a good quarter, and their guidance is also good. And the same thing happened with consumer discretionary, right from autos to including the retail names. And we've recently looked at Arvind, which is a market leader, very good brands, and the company has corrected quite a lot. The company has a couple of restructuring plans going on in demerging its various divisions to unlock value for its retail and textile business. And so that's one thing which we've added in the recent fall. And the other one we added was Ashapura Intimate, manufacturer of women intimate wear and innerwear. And this company is, trading at a far cheaper multiple than all the Page Industries, etc. of the world. And this is a company where it's now trying to invigorate its brand. It's putting out stores out there, standalone stores, and they're increasing their distributor reach. And it's trading at probably at about 18-20 times for earnings well in north of 35-40%. So this is another one which we picked up recently.
I like the fact that the promoter, one, is putting in fresh money. I mean, he's investing himself.
Yes.
And when they did that swap of Ashapura Intimate Fashions with MoMA Apparel, he had the choice of, not leaving out so much on the table for the minority shareholders, but he left. It just shows that the promoter's interests are aligned with the interests of the minority shareholders. Does that work for this company? The reason I also ask this is because aside of the technical trigger, somehow this stock, despite good performances, has not been able to really move up the way the Pages or the Luxes of the world have done.
Indeed, absolutely right. I think this is something which has kind of hurt the sector itself for the last few years. If you look back even at Lovable Lingerie, they got their product positioning kind of mixed up. Were they luxury, were they mass market, were they somewhere in between? They didn't get that act together. But I think now Ashapura is trying to price itself as a mid-premium kind of a brand, and which has not just tier 1 but tier 2, tier 3, the markets are expanding. So, and the valuations are attractive. So I think one, with their execution of distribution reach, and two, brand positioning, maybe this time around it will work for the company.
Would you buy a Page or would you buy an Ashapura if you had a choice?
Well, I've bought Ashapura at about 18-20 times. But Page is a lovely company. It's trading at like, 60-70 times. So I'll stay away from it for now.
The auto pack, you were talking about that earlier on with the results that came out from the two-wheeler pack, a Bajaj Auto versus a Hero MotoCorp. And then what did you make out of the pain points for Tata Motors?
Tata Motors is all about JLR, I believe. And so, whether the CV cycle does well or the domestic does well, it's less important as a driver for the stock rather than what's happening. And that JLR is not going to fix itself until Brexit fixes itself, which is unlikely to happen because there's still no deal for a Brexit. And so against that backdrop, it's very unlikely that...
So no matter how much the stock falls and however cheap it gets, it still doesn't make sense to go into that stock?
No, I guess at some point, but I would still not be a buyer at current levels of Tata Motors. But at some point, if there is a price.
Aside from that, the auto ancillary space now is looking for uniform GST across the board. If that sort of comes in, that will be an additional plus point for the entire sector. Do you think there are good picks out there too?
There are lots of good picks because one of the advantages for auto ancillaries is they benefit from a domestic market, and they also benefit from an export market. And so there's kind of some kind of backstop to their volumes with the domestic thing, with the domestic demand. And with exports markets in general being very strong, the economy is doing well. So this cycle is going to last easily a couple of another years. So we recently did Minda Industries, and so these guys supply to just every single OEM in this country, and they're doing some acquisitions outside the country, and this is both for product know-how as well as in product reach. And this company, so therefore I think it's doing a good job with doing acquisitions. Organic growth is strong and is trading at a fairly attractive valuation, and the revenue drivers are very visible for the company's growth. So this is one of those that we added recently.
It's run up 58% already this year. There's more headroom.
Yeah, there's still a lot more to go, because 58% is, I mean, mind you, the stock had a good amount of debt, there was uncertainty, etc. And so it's coming off a very different base.
Interesting. Well, auto components. Actually, if I can stretch that conversation just a bit more, the one that has not performed is Motherson Sumi. What happens there? Vivek Chand Sehgal seems confident of reaching the numbers that they forecasted for 2020 and reaching that return on capital for the group as a whole at those higher 35-40% odd levels.
He's an excellent entrepreneur, and I've interacted with him several times over the last several years. And one of the things which has held back the stock in the past was the number of acquisitions and some of the group structure. And some of the discount came off. But in times of uncertainty and also what's happening with the trade wars, that uncertainty has held back that stock right now. And I think so that is one of the probably the main reasons which is holding back the stock. And it'll probably, that's more a sentimental thing, which will hold probably water for some more time, i.e. the stock is unlikely to run anytime soon.
Interesting. How are you picking financials, Chakri? My last question really. What are you choosing and why are you choosing them?
Financials, I think, some of these corporate facing banks, they've been, ICICI trades at probably around one times book. So we all know the well-known issues, so we think the stock does well despite the uncertainty. SBI, again, same story, which is the largest PSU bank, 20% plus market share. It's trading around one times book. You know all the pain points well, and therefore that's another one. And Axis Bank, slightly more expensive. Again, well-known story, well-discovered story, similar problem. So it's largely the corporate banks.
You're looking at HDFC?
HDFC, the parent, I think yes, those are like must-haves, the HDFCs and HDFC banks, yes, but incrementally we'll add to the ICICIs of the world.
Like in terms of your investing view, of late, till we actually did see the index rise up, the view was choose those large caps, those quality stocks, but obviously those quality stocks are no longer cheap, they're very expensive, so the value in that buy isn't probably no longer there, versus the mid caps and the broad market, smaller cap space, which seem to be reasonably valued. Which side would you tilt more towards?
It's a very interesting thing. We did some work, and if you looked at, there's only actually 3 stocks, HDFC, Reliance, and TCS, I think, 3 or 4 stocks, which contributed 7.8% of Nifty's return, and Nifty was up about 7.8%. So which means most of the other stocks in the Nifty, forget about the mid caps, many of them were at 52-week lows, and they actually did not contribute. And looking at where the index went is kind of the incorrect way to, that's how the world looked at it, saying that look, Nifty is hitting new highs. It is just actually 3 or 4 stocks which are hitting new highs. So from that perspective, A, it's not an overheated market, and B, in the sell-off, lots of the mid caps have reproved themselves in terms of their earnings are intact and are now at attractive valuations across the board. And primarily actually industrials, consumer durables, because these are the more cyclical sectors. And I think that's where we are finding a lot of companies attractive.
Consumption is a space, value and expense, expensive but valuable?
Yeah, consumption, again, you're going into the traditional festive season for the next several months. And therefore, yes, and value, we're more growth guys, so we see growth out there and we're focusing on that.
Well, focus on value, and a different kind of a conversation today with Chakri Lokapriya, not so much about investing styles as opposed to specific pockets, but maybe the kind of market demanded that. Chakri, take a moment to thank you for joining in today and giving us your perspectives. Really good having you.
Thank you.
Thank you.
And take a break on that note. On the other side of the break, does the Turkish crisis complicate RBI's job of inflation targeting? We speak to Sajjid Chinoy of JPMorgan about the same.
City Union Bank, trust in excellence since 1904. City Union Bank, wishing you a happy Independence Day.
Dreamers, they're everywhere. You've met them, been to school with them, worked with them. They didn't seem different. Yet she's the one who surprised everybody. His crazy idea actually worked.
They are no different. They are you. When you take a chance on yourself.
These are the dreamers who found a way to run the engine of the world. These are the entrepreneurs. There is no formula. There is no right place, right time. There are no overnight successes.
But there is toil, there is preparation, and there is tenacity.
There is no end of the road, no obstacle large enough. There's just the vision and the heart that won't give up.
Because Agons of business never stop.
Agons of business never stop. Only on Bloomberg Quint.
Back with Indian Open right here on Bloomberg Quint. Our next guest is a very special one, Sajjid Chinoy, Chief India Economist at JPMorgan. He joins in to talk about a variety of things. I want to talk to him about one, the biggest problem in the minds of investors right now world over, and that is what's happening to Turkey and the lira and the contagion effects, if any. There's also India-specific things to discuss. IP numbers look solid. Inflation numbers have shown signs of cooling off. I wouldn't call this a trend. So much to speak about. He joins us right now on the show. Sajjid, so good having you. Thanks so much for taking the time out. I want to start off with the bigger issue at hand, at least in the minds of almost all of us who track markets on a day-to-day basis. And that's what's happened to the lira and the Turkish economy and the fears of contagion. Now, the views are divided out there, Sajjid. Some people believe that European banks have exposure. It will show in their P&L. And eventually there will be a sentimental contagion, if not an actual contagion. There is an equal set of people who believe that we don't quite know the extent of the impact that this can have on Asia per se. How have you distilled the noise, and what are your thoughts on what this could do if this worsens?
Morning, it's a great question. I think there are several parts to this. I think the first thing is that policymakers in Turkey need to stop the bleeding, need to stop the hemorrhaging here. And I think the experience of emerging market crises over the last 20 years has shown us is that number one, you require a set of confidence building measures. Policymakers always need to be ahead of the market in terms of ensuring that markets don't lose confidence. The second is there is a very real macroeconomic adjustment that's required in Turkey. Turkey has a gross financing requirement of, $240 billion over the next year. They only have reserves of $80 billion. Inflation is running close to 20%. The current account deficit is, upwards of 5% of GDP. So the second lesson of crisis is you want to spread that macro adjustment across different policy levels and not concentrate that on any one policy lever, because that's typically suboptimal. So I think what we first need to see is some set of announcements by policy makers in Turkey to just build confidence again. We need something on monetary policy, something on fiscal policy, something on how the debt repayment will be managed. I think if that is done to start with, that could, reverse sentiment to some extent. Number two, we need a very real macro adjustment over the next year. And the question mark is, how prepared is Turkey to accept lower growth to restore macroeconomic stability? These are difficult and important questions, but that's what's the need of the hour. In terms of contagion, I think at least on Asia, the direct impact of contagion is very, very limited. The exposure of Asian banks to Turkey, very limited. The exposure is more from European banks and banks in the Gulf. There's about $200 billion of liabilities there and an unknown amount of derivatives. But I think mainly the contagion to the rest of the world is going to be through sentiment. And I think emerging markets with current account deficit countries like India, South Africa, Brazil have gotten buffeted by two or three phenomena in the last month. One is a stronger dollar because US growth has been so strong. The second has been a weaker Chinese currency because China is worried about a trade war. And the third now is that one of its peers, so to speak, is under pressure. So I think the contagion impact on the rest of emerging markets is more sentiment driven. And what you tend to find is once the initial panic settles down, markets become much more discriminating, and from that perspective, India's fundamentals are still very strong and much stronger than they were in 2013. So hopefully, the impact, in the medium term, will be very limited.
So there might not be exaggerated reactions, Sajjid, from what you are saying, but if this were to, worsen even slightly from where it is right now, and well, if Erdogan is to be believed right now, he is not showing any signs of backing off. So whether the strong US economy or whether the Chinese issue that you spoke about, fundamentally, is there a case for the currency to be under, Indian currency to be under further pressure, or do you believe this is the extent of the damage that we could see in the near term?
It all depends on what happens to the dollar and what happens to other emerging market currencies. Hypothetically, if the dollar were to strengthen further, or the lira were to continue falling, you will have at least a little more of this contagion effect around the world. And in that environment, it's very hard to stem the flow. You're almost wasting foreign exchange reserves if the sell-off around the world is systemic, if it's enveloping all emerging markets. So one can never say never. If the dollar were to strengthen further or things get worse in Turkey, it's entirely possible that all emerging market currencies could depreciate further, and in that environment, so will the rupee.
What's the JPMorgan base case, and what is your own personal thought out here? What's the base case, Sajjid?
I think it's less meaningful to talk about a bilateral dollar-rupee rate. I know psychologically that's important. But from an economy-wide perspective, I think what policymakers and central banks look at are what is the trade-weighted rate, right? So it's entirely possible that if the rupee were to weaken going forward, just in line with all of its trading partners, then yes, the rupee could be weaker against the dollar, but against a broad basket of currencies, which is what matters for the economy, the rupee would still be at the same level. I think the RBI and other central banks look at those trade-weighted rates. So in other words, if other trading partner currencies weaken and the dollar were to strengthen, I don't think there should be any sanctity to say that the rupee should not go below 70 or 71. It will depend entirely on relative currency movements. So I think, therefore, with all these moving pieces, it's not meaningful to today target on what the dollar rupee rate is going to be. It's going to depend on how other currencies pan out. I mean, people speculated the rupee will not breach 69, and it breached 69 easily in one day because there was so much stress around the world. I'll just say one more thing, Neeraj. One is that if you look at this trade-weighted rate, the Indian currency has actually strengthened a lot, not weakened. Between 2014 and 2018, the trade-weighted rupee in real terms appreciated almost 20%, right? In the last 6 months, it has, on a trade-weighted basis, given up only 6% of that. So we're still much stronger compared to 2014, and therefore, from the standpoint of competitiveness, it's not a bad thing if the rupee were to gradually, this has to be gradual and calibrated, if the rupee were to gradually weaken, at a minimum, it would need to weaken as much as its trading partners.
Yeah, and excuse me, Sajjid, if I sounded like I was asking for a level. I wasn't, just wanted to know your base case. But, you know, Sajjid, I remember the last year, the JPM conference, you guys and your teams were amongst the first ones to talk about, one, the equities and how they might be reaching a bit of a peaking point, but two, also flagging off the fact that the leeway for foreigners to buy into Indian bonds was so restricted that at some point of time the yields will move up from where they were, and I believe they have. My question to you is, that problem seems to be behind us. The last 4 odd months, the last 2 odd policies, while we moved from 7 to 7.8, 7.9, we seem to be in or around those levels now for the last couple of months at least, and 2 policies have gone by since then. What's your sense of what happens in the near term, especially with the kind of data that we've seen coming out yesterday?
So my sense is, you know, we've had a string of quite strong core inflation momentum prints for the last 6 months, and I think that's what got people concerned, because now if you look ahead and look at inflation in the first half of 2019, the Reserve Bank of India itself believes that inflation is going to be close or above 5%, meaningfully above the 4% inflation target. Now, I think yesterday's print gives everybody some relief here. I think the headline print undershot expectations, but I think the more important information was contained in the details. And what you found is the internals of the print were even softer. I mean, what will give policymakers a lot of relief? What we saw yesterday was the momentum of core inflation, month on month, seasonally adjusted, which had been tracking 0.5% for 8 months, which in other words, that's a 6% annualized rate. That 0.5% momentum in June was revised down to 0.2, and in July that fell further to 0.1. So at least for 2 months in a row, you've seen the momentum of core inflation gap down. Now, you know, it's too early to call victory. In the past, we've seen a couple of months of, you know, soft momentum and then things pick back up. So let's wait and see if this trend persists. Complementing that was the fact that you're not seeing any big food price increases yet. The seasonal increase in food prices this year is more muted than typical, and we've not seen any impact of MSPs just as yet on paddy, for example. So all told, I think from an RBI's perspective, a good inflation print, and I think with the RBI having moved in back-to-back meetings, you know, unless there are some very large unforeseen developments, I think yesterday's print gives the central bank enough space to stay on hold at the October policy review.
Sajjid, my last question, because of you know, the lack of all comprehensive data that the IIP may have, you know, maybe capturing in the recent past, a lot of people have stopped giving credence to the IIP release. Though the release, the last one that came out, seemed to be very impressive. Have you read into it, or are you reading something into this?
Yeah, you're right. I think we should look at the totality of what the high-frequency data is telling us. The recent data flow has been encouraging. IIP was revised up very sharply, and inflation has been revised down a little bit. But I think if you look at the broader mix of data, here's what you find, that we had a very impressive growth recovery for about 2 quarters. And now there's this sectoral divergence where services activity seems to be holding up quite well. But industrial activity and manufacturing, despite the fact that IIP was revised up for a couple of months, is still softer than the end of last year. So I see that there is this sectoral divide that's opening up, where industry is a little bit better than we thought, but meaningfully softer than the last 4 months of 2017. And services, however, continues to impress. I think the way to make sense of this is to say services for the most part are more non-tradable in nature, and domestic demand is holding up quite nicely. The industrial part is a little bit more levered to the export cycle. Exports have slightly disappointed, and therefore industry growth hasn't been as buoyant. I think this is the message that comes through in the credit growth data, in the PMI surveys, and in the high frequency mix more generally.
Sajjid, Chinoy, always a pleasure having you. Thank you so much for taking the time out today and giving us your lowdown on the bigger elephant in the room, which is the Turkish lira and the Turkey problems, but also the Indian data. Much appreciate your time.
Sure thing.
Well, that's the view from Sajjid Chinoy of JPMorgan. We'll of course be talking to him when their India conference is underway in the month of September as well. However, on to earnings. Corporates. Tata Chemicals posted double-digit profit growth in the first quarter, with the specialty chemicals business put him a good show. What hurt though was the plant shutdown in America and the weak operations in Kenya. Radhima Saxena caught up with the company's MD and CEO R. Mukundan and started off by asking him for a better reading on the segmental performance.
Thank you. This is the first time, as you know, we've sort of reported the three segments, and there's been a request and also feel from the management team that we need to sort of show exactly what is the split amongst the three categories, which are as distinct categories in our product portfolio. The largest category for us has been the basic chemistry products, which this quarter is about 2,000 odd crores. We are in the consumer business about 450 odd crores in terms of revenue, and in the specialty products about 600 crores in revenue. And we had already highlighted in several of our reports and several of our meetings that our trajectory is very clearly over a period of time to get the consumer and specialty to account for at least 50% of the company turnover and portfolio. So in terms of ratio, the growth rate in both consumer and specialty will track faster than the growth rate in the chemistry business.
You've also talked about how the consumer segment would reach 5,000 crore in the next 3 to 4 years. How do you plan to do that, and what would be some of the products in the pipeline that would, or the segment that would kind of help that growth?
So broadly, I think the three big movers of that category in terms of revenue are already with us, which is basically the salt, the spices, and the pulses category. I think there's an addition of a couple of other categories which we've launched recently in terms of mixes, nutri mixes, and all the the ready-to-eat khichdi and all that. I think they will all add up to about, broadly in our view, anywhere between 4,000 to 5,000 crores. Any new category we launch will be on top of that. So our plans are to hit these numbers with broadly the range of categories in the market, with the kind of let's say variants which we have in the market.
So do you expect to increase production of of products in the consumer segment, or how exactly would that really map out?
We are firstly increasing the variants in the current categories, so you're going to see a lot more variants in the current categories. But you're right in one point that new categories will come, and we will speak about it as and when we launch. But we are excited about the kind of range of possibilities in the consumer food space and consumer space in general.
There's also talk on consolidation within the Tata Group, that Tata Global would somewhere down the line, Tata Chemicals would become a part of it. Is there any talk right now at the management level about that?
So as far as we are concerned, with the management and with the board, there are no active proposals under consideration. Of course, we do hear of the rumors in the media as and when they crop up. What we are focused on is making sure that we grow the consumer food side, which is basically the solid, food applications, not get into, and there's a clear firewall between beverage and the categories we are going to be in. So we will maintain our focus on the what I call the solids down your throat. The liquids down our throat is not our play. So.
What kind of synergies do you see with Tata Global in case that merger does happen?
We already work with them very closely in several areas. In fact, 3 or 4 of the consumer companies work very closely even as we speak. The Star Bazaar, the TGBL, the Tata Chemicals, and also the farm-centered business, which is in Rallis. We all work together and we look at opportunities where we can cooperate in the entire value chain, and there are distinct learnings which we have in terms of improving synergies, in terms of R&D, in sales and distribution, and learning of best practices from each other. So all these are in place already. So we are part of the group, and that's a benefit of being part of a group which the group brings to us.
The capacity utilization for the company is at 100%, which is also one of the reasons why the margins have remained largely flat at 19% for the past few quarters. What is the kind of outlook that you would have on your margins going forward?
So margin structures largely depend on the growth of segments, and if you clearly see the growth of the basic chemistry products, which is running at flat out at 100% capacity utilization, we have investment plans in India as well as in US, and these will take time to come on stream, about 18 to 24 months. That's when the revenue growth will happen. But largely we expect the margin to remain intact, and that's a function of the strong market demand we are seeing. The revenue growth and the bottom line growth is going to be driven largely by the two other segments, which is consumer and specialty products.
When we talk about geographical expansion, what are the kind of investments do you see going forward into different expansion plans, whether it is of the existing factories that you have or the expansion in the US?
In terms of the expansion outside India, we see investments happening mainly in US. Other than that, most of the investment is going to be happening in India. This is really the growth market. It's really the market where the demand is seen moving forward. So we are really focused on investing in this market for all the three business segments we are in. We have set aside about, our usual number is about 500 or 550 odd crores. This year it will be slightly more. It will be between 700 to 800 crores. That's largely on the back of the investments which are happening in Nellore and Cuddalore. We are building a new plant for nutraceuticals and silica there. US has a capex broadly of about $25 to $30 million, but as I said, the growth capex is about 60. It will be spread over 2 years.
Also, one last question on the growth of the company going forward. You've said that you would continue to focus, the UK operations have started doing well, you would continue to focus on streamlining the debt as well. How do you plan to do that, and what would be some of the focus areas apart from within the consumer and specialty segment?
So firstly, I think the key cash engine for the company remains the basic chemistry business, and I think the cash which it's going to generate over the next few years is going to help us pay down the debt. As at the same time, I think we're going to continue to invest in the consumer space as well as in the specialty product space. And as I said, our final target is to hit to something like a ratio of 50-50 between the basic chemistry products and rest of the two segments, which is consumer and the specialty products.
What about margins?
The margins, I think, varies from category to category. Currently, it's at about 19, but as I said, when you look at food itself as a space, there's a wide range of margin structures which are there, depending on the category you're in. So it would be anywhere between 10 to 20%. So the blended margin may hover around somewhere where we are today, or maybe 1 or 2 percentage points here or there.
Well, that's Tata Chemicals with their numbers. Care Ratings is the other company that came out with numbers. It's a muted first quarter for them. Profits for the quarter fell more than 25% due to low growth in debt in the credit market. The rating agency also added a few new clients in the last quarter. So will the recovery in the macroeconomy revive growth going forward? Let's find that out from the MD and CEO, Mr. Rajesh Mokashi. He joins us right now on the show. Good having you, Mr. Mokashi. Thanks so much for taking the time out and being with us today on Bloomberg Quint. Even if I adjust for the change in the revenue recognition policy, the numbers do look weak. I believe the PAT was down anywhere between 12 to 15 odd percent. What happened in the quarter? Can it change in the quarters ahead?
Yeah, first of all, I would like to say that yes, there were three factors which make the published results look somewhat different, in the sense that the revenue recognition policy which we changed last year, then we have this mark-to-market for our investment portfolio, and then we have an ESOP charge this quarter beginning for this full year coming in. Now, if we do an like-to-like comparison and do an adjustment, then the growth rate comes to, on a console basis, something like 8.29%, which on the backdrop of the current, economic fundamentals is reasonably good, I would say that. And some of our competitors also have announced results which are near about this range only. So we are more or less in line with the industry as such. And the first quarter, what happens is that the revenue numbers are also affected by surveillances which don't unless the annual accounts are available. Surveillances cannot be done by the rating agencies. So there is a lag period taking place, and generally the first quarter is somewhat slow. So looking at the fundamentals, looking at the kind of debt issuances this quarter, which have dropped down substantially for the market as a whole, the credit growth has been anemic as such. So this has been a somewhat slow quarter, but I believe the fundamentals of the economy remain strong as such from the debt market perspective. And that should, we are at least hopeful that the next 2-3 quarters should see a bounce back to more reasonable levels, considering that the GDP expectations are around 7.5%. So that should take off. And so this is not completely in line against the tide in terms of the quarter numbers which are concerned.
Right. So the long-term debt rating, the volume, which I believe has halved in the quarter gone by, will that change quite substantially in the quarters ahead?
I would say that we should understand that the interest rates in the country are rising right now, have begun to rise as such. So and the capacity utilization levels are also not increase. There is still a slack in the capacity. So whether a capex cycle picks up or not is an issue, in the sense that I am not expecting an immediate change in the capex cycle from a private sector perspective. The government of India and the public spending is increasing day by day. That is the only element of capex which is there. So to the extent of refinancing and to the extent of projects being set up, new debt is required to be raised by corporates. But one more interesting factor that in a medium term perspective that I would say is that if you remember the SEBI discussion paper on shifting bank loans to the bond market, that is one interesting dimension. But again, that is to be implemented from April 1, 2019. And we have also seen in the past a few weeks, the RBI paper on working capital splitting between the cash credit and the debt funding, the fixed maturity debt funding. Now these two policy regimes will bring about a substantial shift to the bond market, but underlying credit growth is a function of the GDP and the overall macroeconomic situation, which I believe is improving. The consumption cycle is still intact. The agricultural spending is increasing. The housing finance sector is doing well. So some of these macros are definitely doing well. So
volumes are unpredictable. Let's put it that way. It could happen from quarter 3, maybe quarter 4. Time will tell. What about pricing though? Pricing has been under pressure. Has there been some relief in the current quarter, which is quarter 2, or do you expect the relief to come by in the quarters ahead?
No, I think pricing has always been a challenge for the last few years, if not a quarter as such. So there has not much been a significant change at all. And I think that I don't think there's going to be further worsening of that going forward. It is already pretty competitive. So I don't expect it to worsen, at least going forward.
Okay, so just before we wrap then, just from a perspective of somebody who's invested in the company, Mr. Mokashi, is there any kind of guidance that you have, internal guidance that you could share with your shareholders?
No, I think we do not give any specific outlook or guidance, but all I can say is that if you look at the transformation of the Indian bond market in a medium term, that is the essence of a story for rating agencies. If you look at the way the recovery given defaults are increasing post the IBC coming in, we used to have recoveries of 25 paisa to a rupee. We have seen recoveries on an average of around 50 to 60 paisa, which will shoot up to something like 70 or 80 paisa going forward as the IBC takes root and the results will speak for themselves. No, that will completely transform the bond markets, and a substantial chunk of our 80 lakh crore of outstanding bank funds or bank credit will start shifting to the bond markets, and that will completely, I would believe, change the game for rating agencies. It will be predominantly shifting towards the bond markets, and the bond markets tend to pay slightly better fees than the bank loan market. So in the medium term, I would believe this is a very interesting story, a positive story which is emerging.
Great. We hope it turns around sooner rather than later. Mr. Mokashi, all the best for the quarters ahead. Thanks so much for taking the time out and speaking to us today. That's Care Ratings.
Thank you.
With their thoughts on the quarter gone by. Well, before we wrap up, or in fact, as we wrap up this show, India's richest women include a third-generation heir of Godrej Empire, the chief of a top software company, and the chairperson of the country's leading news group. Together, they have wealth more than the GDP of at least 68 countries in the world. Take a look.